Welcome to our channel Fintoo. Today's discussion is Arbitrage Mutual Funds. So let's first understand the basic strategy behind an arbitrage mutual fund. Well, it is a strategy where you buy and sell a particular instrument on two different markets or exchanges. For example, a particular stock can be bought and sold simultaneously at a BSE and NSE, or let's say a commodity in particular can be bought and sold in the futures and the spot market simultaneously. The whole idea is to capitalize on the price differential between an identical asset which is listed differently in terms of price on two different platforms or exchanges. Now, what is the purpose of arbitrage fund? Well, there can be two. First, you can park your emergency corpus or contingency expenses to the tune of 4 to 6 months, which will help you in any unforeseen circumstances, like how we saw in pandemic. People were struggling with jobs and businesses were disrupted. So in this case, if you have an emergency corpus of 4 to 6 months, you can park it in arbitrage mutual funds because the strategy is safe, it is liquid, and it is immune from any sudden market volatility and risk from market movements. Second purpose of having an arbitrage mutual fund in your portfolio can be to suffice any imminent amount that you are saving for goals. For example, a down payment on a car or maybe a down payment for a house. The whole idea is to protect the funds which you are going to use for your valuable goals, which are due within the next say 9 to 12 months. Now, how popular is this fund in India? Yes, it is. If you look at the AUM of the top 6 mutual funds in India, combined AUM is more than 1 lakh crore, and there is just a minimum SIP of 500 rupees per month that you can start with, or a lump sum amount of 1000 rupees. Now, one can expect a return of 8.5% for 1 year time period, or let's say if you're holding for 3 years, you can expect a decent return of 6.5%. If you have a longer duration, say more than 5 years, 7 years, you can expect a return of 5.5 or 6%. So the return on arbitrage mutual funds will vary on the duration that you hold it for. Now, how popular is it when it comes to expenses and the taxation? Well, the expense ratio for these kind of mutual funds will vary between 0.3% to 0.6% per annum. That is depending on the fund house. And what's best is that if you want to exit out of this investment after 15 or 20 days, there is no exit load. However, if you wish to exit in a very short span of 7 days or 10 days, you would have to bear an exit load of 0.5% approximately, depending on the fund house. Taxation, however, is not very complicated. Taxation for arbitrage mutual funds is very much in line with what you have in equity mutual funds. So if you are exiting the arbitrage strategy under 1 year, then your profits are taxed at short-term capital gains basis, which is 20%. If you are exiting after 1 year, which is a period of more than 12 months, then you are taxed at 12.5%. So the taxation is very competitive than that of the liquid funds or other debt mutual funds, where otherwise you will be taxed at your tax slab. Thank you very much. Stay tuned for further updates.